Hello, everyone. Today we'll talk about chapter 16, the money system and the Federal Reserve. Okay, so there are two major parts in this chapter. We'll first talk about the money system, how commercial bank can create money, and then we'll move on to talk about Federal Reserve. So let's see some questions we try to find the answers in this chapter. The first one will be, what is money? The definition of money and the functions of money. Then we'll move on to talk about what is the Federal Reserve. Then we'd like to move on to talk about what role do banks play in the monetary system? How do banks create money? So here banks referring to the commercial banks. And then last, we'd like to talk about how does the Federal Reserve control for money supply? Let's begin with the first one, money definition. So without money, then trade would require barter, which means the exchange of goods and services for another. So for example, if I have a dozen of egg and then you have a bag of onion, I need a bag of onion and you just need a dozen of egg. Then we can exchange those two goods for each other, right? This is what we call barter. So you might notice in this type of transactions, it needs some coincidence requirements, coincidence needs. For example, I just need onion and you need a dozen of the egg. Then that can make these transactions happen, right? If I need a pound of the beef and then you only have a bag of the onions, then this type of transactions actually cannot be made it. This is what we say in a barter transaction. Every transactions will require double coincidence once. And if there is no coincidence once, then this type of transactions cannot be successful. So we need something that can be act as a medium that will be money. Okay. So most of people would have to spend time searching for others' trade, and this will be a huge waste of the resources and huge waste of the time, right? During the barter transaction. And this type of research will become unnecessary with money. So money is the assets that people regularly use to buy goods and services from another, right? And this is what we use very commonly today because money, this is the definition, okay? Money will be the assets that people use to make and receive payments when buying and selling goods and services. Let's look at some functions of the money. So we would like to say money actually has three functions. The first function, we use money as a medium of exchange, which is an item that buyers give to the sellers when they want to purchase goods and services. So for example, if I want a dozen of an egg, I just need to the grocery store, I pay for that. I use money to pay for that, right? Money can also use as a unit of account, which will be used as a yardstick that people use to post prices and record debts. So for example, a dozen of egg will be $3 at a grocery store. Okay, so $3 is the yardstick or is the price of the dozen of the egg in a grocery store. So this is the second function. The last function of the money, we use it as a storage of value. So which means people can transfer the purchasing power from present to the future. For example, I can save my money into my saving account and then I can use the money later. So this is the function as the store of value. Okay, so those are the three important functions of the money. First, as a medium of exchange, and then we can use it as the unit of account to mark the price of the products. And then the last function of the money, we use it as a storage of value to transfer the purchasing power from present to the future. Now let's look at two different type of the money. So one type of the money we call it as commodity money. What is commodity money? So commodity money actually has intrinsic value. So like the gold coin, like golden coins, or like the quarters, the nickels, the pennies, those actually has intrinsic value. Okay, if we treat it as commodity. And another type of money which will be just a dollar bill, okay, we call it as flat fiat money, okay. So fiat money has no intrinsic value. The example is just the paper currency that we use today. So for example, if currently I have a currency like the fiat money, a dollar bill from China, a Chinese yuan in my hand, actually that type of the money cannot use here because people has no common recognition of Chinese yuan here in United States, right? So this is what we said why American dollars are so valuable because it has the global recognition. If you use the US dollars in China to purchase the products, it works. However, if I use the Chinese dollar bill here in United States try to purchase a product, it doesn't work. So this is what we said for the fiat money without a global recognition, it's just a piece of paper. Okay. Now let's move on to talk about money supply. Actually, we mentioned the money supply in chapter 15, right? We said money supply comes from national savings, right? And the money supply is the quantity of the money available in the economy. What assets can be considered to be part of the money supply? In this chapter, we have two candidates. Okay, the first one will be the currencies. So currencies will be just the monies, including the fiat money, the coins that holding in the hands of their households. And the second candidate for money supply comes from demand deposits. So those are the balance in the bank accounts that depositors can access on demand by writing a check. Okay, so those could be the money in a checking account or saving account. So remember, these are only two candidates we considered in this chapter for money supply, currency and the demand deposits. Now let's look at the business of the banking. Those shows the business of commercial bank. So for the households, okay, or for the others, they have the money in hand, right? But they can decide to save their money or put their money into their bank account. So bank was in the middle, okay. And then once the bank receive those savings from households, bank can do what business? Bank can make loans, right, with those monies. So bank do not print money. I mean, for commercial banks, they don't print money, but their actions can affect the total money supply. We would like to talk about this in the next slides. Okay, so you can see here in this graph, okay, in this figure, bank in the middle as a medium, okay, intermediaries to allocate money, okay, to reallocate money. So for savers like households, they can put their actual money into banking account, like saving account. Then bank can utilize, okay, can reallocate those savings to make loans and then make profits. You can see this is the bank's own, this is the interest rate shows on the bank deposits and loans. The red line here shows the loans rate, and then the blue line here shows the deposit rate. You can see there is a gap, right? So the gap will be the bank profit. The differences, okay, the differences between the long interest rate and the saving interest rate, those are the bank's profit. And this is the introduce of bank balance sheet. We will use this balance sheet pretty often in the later slides. Okay, so you can see in the bank balance sheet, including two parts, liabilities and assets, right? So liabilities will including the deposits. So you're including the deposits, the borrowings, and then the owner's equities. For the assets, okay, we're including like the loans, the reserves, the U.S. Treasury securities because banking can use those money to invest in U.S. Treasury securities, and then for the other assets. So you can look at in this bank balance account, okay, in the balance sheet, the liabilities, the total liabilities should equal to the total assets. So all equal $800. The loans will be the primary interest earning usage of the bank's funds. And the reserve. So reserves will be required by the Federal Reserve. Okay, Federal Reserve is the U.S. central bank. So reserve will be the bank should set part of their deposits in Federal Reserve as required, including the currencies at a value and holdings at a Federal Reserve. Okay, so this was the explanations about what reserve will be. Now let's look at for a banking system. So in United States, we currently has the fractional reserve banking system, which means when consumers deposit some money into a bank should keep some fraction of that type of their of that saving as part of the reserve. So bank only holds a fraction of the deposit on reserve, and typically it will be 10%. Okay. Before 2008, those reserve that bank holds, putting in the Federal Reserve, has no interest. However, after financial crisis, in order to encourage bank to save not more fraction of the reserve in the Federal Reserve, then Federal Reserve start to paying interest for those type of the reserve. And you can see this is the fractional banking system will work. Households put their deposit into a bank, right? And then bank can make loans. So first, this will be the deposits, right? So when those deposits go to the bank should keep part of this deposits as reserve. This will be required. This part is required. This part is required. And then the rest of the deposit, bank can make loans. When bank made loans, actually it can earn the interest rate from making loans, right? So this will be making the loans. Now, there are some reasons why the bank should hold these reserves. Why this part should required. There are some reasons. The first one will be to accommodate customers' withdrawals. If there is a huge number of the customers' withdrawals and there is no reserves, then bank would probably will have a bank run. And then those requirements, those reserve was required by the Federal Reserve, the central bank in the United States. So the required reserve ratio, typically 10%. Okay, this one will be have a required reserve ratio. Required reserve ratio always abbreviated as RR. Okay, so this required reserve ratio would be the proportion of the deposits. Okay, will be the proportion of the deposits. So you can see the current reserve ratio will be 10%, which means if you deposit $100 into a commercial bank, the bank should reserve $10 and then it can then make loans of the rest of $90. The required reserve will equal reserve ratio times deposits. Okay, required reserves here will equal, so this reserves will equal reserve ratio times deposit. If bank do not have this type of the reserve and then facing a huge number of the customers withdrawals as I just talked about, then bank might face the bank run. Okay, so bank run may end with bank in default, and most of banks should avoid this. Now let's look at some preliminaries before we move on to talk about how bank can create money. So first will be the reserve ratio, as we just talked about. Reserve ratio was required by Federal Reserve, the Central Bank of the United States, and this is abbreviated as RR. And there are two different type of the reserve banking system. One is 100% reserve banking system, which means if consumers deposit $100, then bank should save this $100 in the Federal Reserve. Okay, and this is really nonsense because bank cannot make any interest from making loans. Now, the second important reserve banking system will be the fractional reserve banking system, which will be bank will just hold a proportion from the deposit as a reserve, and they can make loans of the rest to make interest. And then here we just assume a bank liabilities only includes deposits, okay, from the bank balance sheet. The liabilities only including deposits, and the assets only includes reserve and the loans. So in the bank balance sheet, okay, so I will say the balance sheet, we will have the liability, right? And then we'll have the assets. So the liabilities only including deposits, okay? And then the assets here, we will have loans and reserves. So this is the simplified, okay, a very simple balance sheet. Now let's look at the first one, the bank T account. T account. What is bank T account? So T account is a very simplified accounting statement that shows bank assets and liabilities. So for example, this is bank T account. This is what we call the T account. Okay, it only includes liabilities and the assets. So you can see the deposits here will equal $100, and then as we talk about the current reserve ratio is 10%, which means we have the $10 as reserves, and then $90 can make loans. And then you can see from this T account, we have the deposits equal 100 here, from liabilities, right, to 100. And then the assets here, we also have 100. So they equal to each other. This is what we call it's a balance sheet. Okay, it's a balance sheet. Now, bank liabilities, including deposits, assets only includes the loans and the reserves. In this example, because the reserves equal $10, so we can have the reserve ratio equal $10 divide $100, which will be 10%. Okay. Now let's move on to talk about how bank can affect the money supply. So to understanding the role of the bank, we will consider three scenarios. Okay. The first scenario is if there is no bank, what will happen? Okay. For the second scenario, we would like to talk about if there is a 100% reserve banking system. And then for the last one, we'd like to talk about our current banking system, fractional reserve banking system. Okay, so we will analyze these three scenarios and then to talk about how bank can create money. So in each scenario, we assume currency, okay, currency will equal $1,000. So here, currency equal $1,000. So for the case one, if there is no bank, no banking system, what will happen? Public just hold $1,000 as currency. So we have currency as $1,000, no bank, which means the deposit here will equal zero, right? And as we just talked about, we only have these two candidates as money supply, right? So money supply M, money supply M here will equal the summation of C plus D, then would just equal $1,000. Okay, so if there is no bank, then currency deposits, we sum them together equal money supply, $1,000. Now, let's look at if we are now facing 100% reserve banking system, what will happen? Initially, we have currency equal $1,000, right? And then deposit equals zero. So money supply in this case equals C plus D equal $1,000. This is initially. Then households or the public decided to put this $1,000 into bank, right? Then we will see in the bank, first bank, okay, we have liability, right? We have assets. If households now or if public decided to put this $1,000 into bank, then we have the deposits will equal $1,000, right? This will be our deposit, D. Then this will be the deposit, and deposit will just equal $1,000, okay? This is D. Now, how about the assets? Bank received this deposit, and then he need to put the money into reserve, right? Bank need to put the money into reserve, and the rest can make loans, right? However, with the 100% reserve banking system, the reserve should equal 100%. This is the reserve ratio times the deposit, $1,000. So the reserves should equal $1,000, and bank has no money, no extra money to make loans. So the loans here will just equal zero. So zero in loans, right? But the reserves will have $1,000, right? Reserve will have $1,000. So totally you can have in this T account, after the deposit, okay? After deposit, we have currency. We have currency will equal zero. Deposit equal $1,000, okay? And then we have money supply still equal C plus D equal $1,000. So in a 100% reserve banking system, okay, in the 100% reserve banking system, no impact on the size of the money supply.